Inflation is both rising and falling at the same time. Sounds crazy, right? That's exactly what happened with the latest CPI and PPI numbers. Consumer prices slowed down, but producer prices ticked up. So what's going on? Is inflation easing or coming back? And more importantly, what does it mean for your wallet, investments, and interest rates? Let's break it down. CPI versus PPI. Let's start with definitions. CPI is the Consumer Price Index, a measure of prices paid by you and me for everyday items: food, rent, gas, clothing. PPI is the Producer Price Index, a measure of prices received by businesses that make goods and services. It tracks inflation at the wholesale or input level. You can think of it like this. PPI equals what businesses pay or receive. CPI equals what consumers pay at the end of the chain. Usually, they move in the same direction, but not this time. This month's numbers. The split. Here's the shocker. CPI came in lower than expected, signaling cooling inflation for consumers. But PPI was hotter than forecast, showing rising costs for producers. This divergence has economists scratching their heads. Why is inflation falling at the consumer level, but rising at the producer level? Let's unpack the reasons. Why PPI rose? While CPI fell here are the three key reasons. 1. Energy and commodities. Lag producer prices are more sensitive to oil, metals, and raw materials. If input prices jump, even temporarily, it shows up in PPI before CPI. 2. Profit margins. Took the hit. Some companies are eating higher costs instead of passing them on to consumers, to avoid losing customers. That keeps CPI low, but pushes PPI up. Third time lag. Between PPI and CPI-PPI often leads CPI. If producers face rising costs now, it may not show up in consumer prices for another 1 to 3 months. So, the CPI drop may be temporary. The PPI spike could be a warning of inflation to come. What it tells us about the economy. This CPI-PPI gap is more than just a data quirk. It's a signal of economic tension. On one hand, consumers are getting relief. Retailers are cautious about raising prices. Inflation headlines are cooling down. But under the surface, business costs are climbing again. Margins are tightening. Supply chain frictions are creeping back in. It's a tug-of-war between short-term stability and long-term inflation risk. What will the Federal Reserve do? Here's the million-dollar question. The Fed watches CPI for inflation targeting. But it also tracks PPI as an early warning system. This split gives the Fed a dilemma. If it focuses on CPI alone, it might cut rates too soon. But if it focuses on PPI, it might pause rate cuts, or even hike again. That's why markets are suddenly uncertain. Bond yields wobbled. Rate cut bets were scaled back. And the Fed's next move? Anyone's guess. What this means for you. Let's make this real. If you're a consumer, you may enjoy stable prices for now, but don't assume it'll last. If you're a business owner, rising input costs mean you need to revisit pricing strategy. If you're an investor, this divergence could affect sectors differently. Oh, good for consumer discretionary stocks, short-term, oh, risky for industrials, commodities, and energy. It's also a red flag for anyone assuming the Fed is done fighting inflation. They may not be. Final thoughts. So, CPI is down. PPI is up. Is inflation over? Not quite. This isn't a contradiction. It's a warning. The surface looks calm, but pressures are building underneath. Think of it like a dam holding back water. The cracks are there. You just can't see the flood. Yet. If you want to stay ahead of what's really happening with the economy, subscribe to Finance Related 101. We break down the noise, decode the data, and help you navigate what's next. Stay sharp. Stay skeptical. Stay prepared.